Hi, this is Alan Donald with Keller Willliams Realty, and today I'm going to talk about property taxes and capital gain taxes on the sale of real estate. Hang in there. Before we get into the taxes, let's review some key terms for real estate property taxes. The property tax is calculated using the appraised value, multiplying it by the assessment ratio and then by the millage rate. The appraised value is the base value of the property considered to apply the tax, and it is important to consider that it resets to the purchase price at closing. The assessment ratio is the proportion of that appraised value that is used to calculate the property tax. 6% is the default rate. It does reset at closing, and it is also applied to second homes or investment properties. If you live in it as your primary residence, you can apply for a primary residence exemption that would lower that assessment ratio to 4%. In addition, if you're over 65 and have lived in that home as your primary residence for more than a year, you can request a homestead exemption that exempts the first $50,000 of value from taxes. The millage rate is the tax rate applied that depends on the county, the municipality, and the tax district. So different properties in different counties, municipalities, and tax districts are taxed at different rates. Now let's talk about capital gains tax on the sale of real property. Capital gain is defined as the appreciation of the asset during the time you owned it. The tax on capital gain depends on your income, your tax filing status, and the length of time that you own the asset. Federal level, there's 0, 15, or 20% tax rates. South Carolina taxes capital gain as income. There's a 44% deduction on a long-term gain basis, and the maximum rate is 7%. If you have lived in the property for at least 2 of the last 5 years before selling it, there is a capital gains exemption of $250,000 for an individual and $500,000 for a married couple. Let's run a couple of examples of sales of property and the calculation of capital gain tax. First example is that of a couple who bought the home for $400,000 in 2010, sold the home for $800,000 in 2023. So the gain is $400,000. And because it is within the $500,000 exemption, they wouldn't pay any capital gains tax at a federal level. The second example is this single person who bought the same home for $400,000 in 2010, again sold the home for $800,000 in 2023. That person would be paying tax on $150,000, which is the amount that exceeds the $250,000 capital gain exemption for individuals. South Carolina requires the buyers to withhold capital gain taxes for non-resident sellers. The amount is based on the gain recognized either in the seller's affidavit, the amount realized, or the net proceeds. It is the buyer's responsibility to collect and remit the withholding to the South Carolina Department of Revenue. There are very specific conditions for deducting mortgages, liens, and advances from the capital gain. And normally, this withholding tax is collected at closing by the buyer's closing attorney. The seller has responsibilities of reporting the sale on a South Carolina income tax return. That's why they withhold the tax, so that to make sure that any seller reports the tax in an income tax return to South Carolina. The seller affidavit is to apply the withholding amount against the income tax due. And the seller is responsible for filing all the necessary forms and attachments for proper documentation. Who qualifies as a non-resident seller? Any individual with a permanent home outside South Carolina. Any corporation incorporated outside the state. Any trusts administered outside South Carolina. Any partnerships with a principal place of business elsewhere. And any estate of decedents with a permanent home outside South Carolina. There are some strategies that you can use to mitigate some of those taxes. However, Before you conduct any transaction, please consult your CPA or your tax attorney. We are not attorneys, we are not CPAs. This is just for information only. The first strategy is to establish a rental property as a primary residence and live in it for at least 2 years before selling. And that way you convert an investment property that was liable to capital gains tax. You can convert it into a primary residence, which is exempt of $250,000 for individuals or $500,000 as a married couple. The second strategy would be to buy another investment property by reinvesting the funds using a 1031 exchange to delay that capital gain tax liability. The third strategy would be investing in opportunity zones for potential tax benefits. Those are zones designated by the IRS for special tax exemptions. The last strategy is to add all the expenses to the cost basis: repairs, improvements, losses, and closing costs. So if you buy an investment property, keep track of all your expenses in case that you can add them up and increase your cost basis before you sell the property. I hope this information has been useful for you. If you have any questions, please give us a call at 843-900-0155. And remember, we are not accountants, we are not tax attorneys. So before you make any decisions, please consult your CPA, your accountant, your tax preparer, or your tax attorney. Thank you very much, and until the next one.